Markets had a rough day Wednesday, with the S&P 500 falling 4.4%. The financials, utilities, and real estate sectors led this charge, each falling about 6%. The Dow Jones fell 4.44%, making a 29% fall from its peak. The Nasdaq fared just as poorly, falling 4.4%, making a 25% drop from its peak. In Canada, stocks are also down, with the S&P/TSX Composite down 3.75%, making it over a 28% loss from its peak. In Europe, the FTSE is currently trading up 70 basis points, while in Asia, the Nikkei didn't have a good night, falling over 1%. There is a slight recovery in the oil markets, with WTI and Brent crude almost up 10%, but taking the previous fall into consideration, it really isn't much of an improvement. Gold was also up almost 1%. In the Treasury markets, we saw a pretty sharp fall in the 10-year yields of both the US Treasury and the Canadian 10-year Treasury, with the Canada at 61 basis points and the US at 59 basis points, both falling about 8 basis points on the day. In the currency markets, the British pound, the Australia dollar, and the Canadian dollar all had a strong day, while the euro and Japanese yen struggled. With a recession looming over us, many governments have taken to creating massive fiscal deficits this year to try and combat the effects of the global pandemic, to try and offset it so the recession won't be too bad. But this article makes an interesting point about a possible debt crisis that's actually coming from the European Central Bank, suggesting that if the countries in Europe don't work together, that they could have a sovereign debt crisis. This comes off the bat of in the past years where there was actually a sovereign debt crisis in Greece, being one of the members of Europe, which could be a weakness, as currently Greece has 180% debt ratio, so having their sovereign debt to GDP, while Germany's is only 60%. With Britain recently leaving, this really puts into my question whether or not the EU will really be able to survive this, as you really have the issue of different governments pledging different amounts and could really have effect on that euro, especially if they don't really listen to the European Central Bank or the European governments and more focus on their nation as a whole. Overall, this article is saying that they expect debt levels to increase by 10 to 20% based off of the spending. It's hard to say exactly if there could possibly be a crisis, but it's always something to keep a watch out for, especially with the amount of debt that's being increased. With everything going on in the world, I keep saying it really doesn't make sense to have an oil price war right now. If anything, should be put on hold, but doesn't look like that's going to happen. As this report says, U.S. President Donald Trump not only spoke to Vladimir Putin, but also Saudi Arabia to try and discuss the current levels, but it doesn't look like Saudi Arabia will cut their production. What it does say, though, is that Saudi Arabia is only going to plan on cutting production if the major producers around the world, so that'd be including the U.S., also cut their production as well. Russia's also saying now, though, that they won't raise output because it isn't profitable for them to raise their output right now, which is kind of interesting. So in a way, it means they won't be escalating the price war anymore, at least. But considering where things are at and the demand for oil is significantly down, it says here it could be down as possibly 30%. And you get places like Iraq's also increasing their production. It's hard to see where things are going to go. On the upside, though, oil did have about a 10% up yesterday. While many things have been put on hold, one thing that hasn't is bond market issues, with many big companies announcing that they plan to issue high amounts of investment grade bonds in the market as they try and help themselves have a certain amount of cash and be able to survive this pandemic and recession coming. In the US, investment grade issues were 259 billion, which is a new monthly record. It's a lot of bond issues to happen recently. And in Europe, they had a total of 148, which is the most since 2016. So right there you can see just how much companies are borrowing to try and offset what's going on. In total, though, this is actually the worst month for bonds since 2008, with US high yields down 11.5% and investment grade dropping 7.1%. Also, this year the European index lost 6.9% in March, which is its biggest loss ever. Also in Asia, right here it says spreads on top-rated Asian dollar bonds ended the first quarter 146 basis points wider, the worst blow since 2009. So there's a lot going on in that bond market with people losing money, but as well as a lot of people trying to issue a lot of new debt, as many companies really need to try and do something in the current situation. Europe is also looking to increase the amount of issues with about their busiest day coming soon, as expect 17 deals are currently in the works. In company news, Macy received some bad news that they're actually being removed from the S&P 500 into the S&P Small Cap 600. This really isn't good news for them, as this will affect certain people that will buy, because many people do buy ETFs and indexes that try and match the S&P 500. It shouldn't affect their stock too much, but it really just shows you how poorly Macy's been doing in the past few years. As you can see, Macy's has lost 70% of its value so far in 2020. And just looking back to its peaks, back in 2015, Macy's stock value was around 23 billion, but yesterday it was trading at about 1.45 billion market cap. This comes off the bat of them also announcing that they're laying off a majority of their 125,000 workers. This is a tough time for Macy's, especially with the way the industry has been changing. They really haven't been able to combat that. The automaker Linamar is the next Canadian company to announce that it is going to change its production to try and help fight the global pandemic in Canada. So they plan on making ventilators in Canada, so switching from their normal manufacturing of auto parts. In total, though, the government has also agreed in a signed letter with about five companies in their intent to help them make different products. One company, Irving Oil, is also planning on making hand sanitizer in their oil refineries, as well as Bombardier and 3M might also be looking to help make certain products. Canada Goose has also announced that they're making scrubs and patient gowns and are actually planning on donating these to the hospitals. Earnings season is really starting to kick off, and we got Corus Entertainment with their Q2 earnings just reported. Their net income was 18.5 million, up from 6.3 million the previous year, with earnings per share of 9 cents, up from 3 cents the previous year. On an adjusted basis, they had an earnings per share of 12 cents, which is up from 7 cents a year earlier. On the downside, though, the revenue fell to 376 million from 384 million. But with a company like this that focuses on that entertainment industry, especially reliance on subscription and advertising revenue, there has been a lot of weakness in that advertising revenue. And just looking at those numbers, their ad revenue fell 6% in Q2, and year to date it's down 2%. Based on pro forma, it is down 5%. Really not a good look for Corus Entertainment, as they have been struggling trying to not only maintain but even possibly grow their advertising revenue for the past years. Dollarama also reported their Q4 earnings, with earnings per share at 57 cents, which is up from 53 cents the past year. Sales were 1.07 billion, but it says here that that's based off of a 13-week period, and last year's was based off a 14-week period, but it's still up from 1.06 billion the previous year. They did suspend their guidance for their forecasts amid the pandemic, as there isn't much clarity on what exactly they'll be able to achieve. But most of their stores are still open, so they won't take a brunt of the damage like other companies might.